Hi everyone, welcome to the Contra Turtle Show, where I reveal YouTube's most transparent portfolio and my journey towards 4.5 million Sing dollars over the next 12 years. In today's episode, I'm going to talk about how I lost 105,000 Sing dollars in the stock market over the last 2 months and 4 tips to bounce back. It's important that I transparently show everything because I don't want you to judge me just on my winners, but to also judge me when I'm losing. Around mid-February, my portfolio hit an all-time high of 518,000 Sing dollars, equaling a profit of 270k after 4 years of investing. Then, the tech sector corrected massively due to valuation concerns, and Trump introduced his tariff plans, causing the portfolio to dip to 413k, which is a 20% drop in value. I lost 105,000 SGD in portfolio value. So here are 4 tips on how you can bounce back from such dips. Over the last 100 years of the financial markets, there have been all kinds of crises. We had pandemics, the Ukraine war, trade wars, government shutdowns, the 2008 financial crisis, oil crisis. But after each crisis, the S&P 500 always bounced back up and continued its long-term uptrend. So why is it that people don't remain invested in the market, or better still, use this crisis as great investing opportunities? The problem is that every time a crisis happens, you will always hear this statement: this time is different. Do you all remember back during COVID in Singapore, people were panic buying groceries at NTUC to hoard all this household goods at home. It was ridiculous. I remember even the rice ran out at my neighborhood supermarket, and the government started putting limits on how much you can buy. And then everyone had to mask up, and you had to maintain social distancing everywhere. It felt like the end of the world, like we would never go back to the pre-pandemic days. And I remember very clearly when we were asking, hey, is this a good time to invest? When families and friends were talking about the markets. They will always say, you siao ah, pandemic leh, everyone can't travel, the economy taking a hit, better save money lah. Then when you tell them, but we had SARS before in 2002 what? Everything also shut down. And then you get the magic sentence again. This time is different. This pandemic is different. Very different from SARS. It's a global pandemic, right? This and that. So in the end, most people still kept out of the market and they didn't use this opportunity and they didn't invest. Or if we go back to 2008 after the great financial crisis, do you remember that the COE prices of cars in Singapore dropped to $2, guys? Because nobody was buying cars. People were losing their jobs. Singapore was in a recession. Everyone was cutting back on consumption. $2 COE leh, guys, compared to today leh. What is it today now? It's like 6 digits or something. That's cheaper than a plate of chicken rice at $2. And then again, I remember during that time, during the financial crisis, for months on end, a lot of friends and family around me during this time were like, oh, this financial crisis is so bad. Worse than the 1997 Asian financial crisis that Singapore went through. You all better save all your money. Don't anyhow invest or don't anyhow buy this and that in the markets. It's not a good time now. Again, the reasoning is this time is different in 2008 compared to what happened in 1997. So you should not invest in the market. In fact, you should just sell everything right now. Sell everything right now and stay out until the coast is clear. But if you followed everyone's advice and stayed out of the market, or worse, you sold out all of your positions during all this crisis because you listened to all the uncles and aunties, then you would have lost out because of 2 reasons. Firstly, the worst days in the markets are usually followed by some of the best days in the market, like what happened last week. When the S&P fell nearly 6% after the Trump tariff announcements, 5 days later on Wednesday, it rose by a historical high of 9.52% in a single day. Secondly, there is an imbalance between gains and losses. What do I mean by this? Let's say you buy a stock at $100. Then a crisis like the Trump tariff war hits, and then you lose maybe 20% of the value of your stock. So it now goes down to $80, right? When the stock gains back up to $20, eventually, if it goes back up to the original $100 price point, you actually didn't just gain 20% in returns. You actually gained 25%. Why is that so? Because mathematically, the new denominator of $80 is smaller than the original $100. So on recovery, the percent gain is higher than the percent loss to go back to the same point. We call this the asymmetry of gains and losses. In fact, if we expand this even further, here is a table that shows the gains you get after recovering from a dip of various percentages. It goes all the way from 5% all the way up to 95%, which is almost a complete loss of all the money. Which is crazy because the corresponding gain for that is 1,900%. So I think if a stock ever goes down minus 95%, there's probably something fundamentally wrong with it. So I don't think that's a line that you want to look at, but you get the point. Now the problem is that the deeper the dip in the prices, the less likely most people will want to invest during times like COVID and the 2008 financial crisis, exactly like how I described just now, because of the amount of pessimism and uncertainty at that point in time. There is always an excuse. There's always something is different this time. But if you think about it, it's precisely this uncertainty where if you invest at those times, you get the corresponding payoff. So if you want to perform better than the average folk, then you have to almost rewire your brain entirely and appreciate that these worst times are in fact the best times to invest and to be contrarian to everybody else, because otherwise you will get the same mediocre returns as everybody else. Now, there is an important caveat here I want you to take note of, which is that it is super important that you keep at least 6 months to a year's worth of savings before investing the rest. Because you don't want to be in a position where you run out of money for your household expenses and you're forced to liquidate during a recession, which is the very time you should be doing the opposite and holding onto what you have, or in fact buying more instead to get outsized returns. You never know how long this recovery will take, and there's also a high chance that at the same time that you're doing these investments, you're going to get hit with a retrenchment, as we've seen the last few years. So when this recession hits, you lose your job, this will make it even harder for you to pull the trigger to invest or to remain invested. So please guys, the caveat is always have this 6 months to a year or more savings, up to you to decide, on standby before you invest the rest. Then you can ride through all the ups and downs. And it's for this reason, on the very day when Donald Trump tanked the market, I bought 10 units of Meta's stock, entering at a price of 535 USD for a total of about 7,050 Sing dollars. So when Meta had tanked by about 27% from its previous all-time high, now as I show you this chart, I know what you're thinking right now. How come you didn't wait for a few more days? Maybe the market will go lower. You could have gotten even lower price at 481. That's $54 lower than your entry price of 535. Wow, you lousy lah. And this is when I want to talk about tip number 2, which is nobody can catch the bottom consistently. The keyword here is consistently. You may catch it once or twice or 3 times by luck before, but that doesn't mean that you can reliably get the bottom every time. I'm talking about the absolute bottom here. If anybody tells you that they have some special mathematical indicator combining the MACD, the RSI, support resistance levels, yada yada yada, volatility indicators, this and that, and then they say, tomorrow 100% is going to be a green day, that is being a false oracle. Because even the real oracle of Omaha himself, Warren Buffett, never managed to catch the bottom throughout his investing career. For example, if we look at his purchase price of Apple back in 2016, it was an entry price of $109 back then. This was before the 4-to-1 Apple stock split, right? After he bought it right at the top of the red candle, if you see in this diagram. Immediately after that, I remember this very, very clearly. A few weeks after that, it immediately dropped by 17%, the whole red bar and then some more in the next bar. And during this time, I remember very clearly everyone on CNBC in the market, they were writing, all the hedge funds, they were bashing him. They were saying Warren Buffett is such a poor, stock timer and how overvalued Apple was at that time. But needless to say, many years later, as we zoom out to a longer term horizon for Apple, the temporary 17% drop in 2016 when Buffett first bought it was more than made up for with a 7 times gain over the next 9 years. So remember, nobody can time the bottom. Nobody, not even Warren Buffett. So what makes you think you can? And even if you cannot time the exact absolute bottom, it does not matter, guys. Because over the long-term horizon, whatever 10-15% drops you experience after you buy in on a dip, and it dips even more by 15-17%, does not matter in the grand scheme of things over the long-term horizon. It doesn't, as I've just showed you with Apple and what Buffett did. And so with this in mind, it's important to have something else in mind, which brings me to tip number 3. Hey guys, before I go on to tip number 3, can you all please smash the like button and click subscribe? The last video I had over 2,000 views but only 40 likes. What the hell, guys? Come on, man. What are these numbers? Show a Singaporean brother some support, guys. Can we have some W's in the chat or questions in the comments, please? Thanks, man. So moving on to tip number 3, the right company at the right valuation. Now you can do all the right things I've mentioned so far by being contrarian in your mindset, being long-term optimistic, buying on dips and all that. But if you've bought the wrong companies at the wrong prices in the first place, none of the things I've mentioned so far even matter. Because firstly, without the right companies in your portfolio that have a durable competitive advantage and good management, buying them during a crisis won't provide you outsized returns because these stocks simply won't recover to what they were before after they tank, right? Because they simply can't stand the test of macroeconomical or political factors and time. So take for example the classic of BlackBerry. Before the 2008 financial crisis, BlackBerry traded up as high as $150. Then when the 2008 financial crisis came, it went all the way down and it never recovered even until today, 17 years later. Yes, it's still on the market. It's still being traded in the public markets. So what happened? I think everybody knows the answer. It's very simple. The iPhone was released in 2007. And from then on, it already started to take market share from the BlackBerry. There were already signs in the market. I don't know if you remember, but it was very clear that Apple was becoming a serious threat to the market of BlackBerry. So it's important that you identify the right companies to make this work. I won't go into too much detail on how I select stocks, but I've put a link here of a previous video I did in the top right corner so you can take a look on the 8 steps and the criteria that I have before I select a stock. But then you might ask, what about the right price? Now, borrowing from Brian Stoffel's valuation charts. Brian Stoffel, I think they run this other YouTube channel called Long Term Investing. You should check them out. They're really interesting sharings they have over there. I've learned a lot of things from them. I'm not affiliated to them, but I just follow, I subscribe to their content and I enjoy it a lot. Borrowing from them, they once showed this chart which I've saved until today. And this is a chart that actually, you can value companies based on where they are in the growth cycle. So for early growth companies on my portfolio, like maybe Exxon, they have just become net income positive. I look into the historical price to sales ratio and I compare it to the historical average. And for the other companies on my portfolio, like Amazon, Meta, Netflix, and Mercado Libre, I look into the DCF, reverse DCF, PE ratios, or price to free cash flow ratios, and then I compare it to the historical average before I make a judgment on the price. Now, Amazon is an exception because I prefer to use price to operating cash flow, simply because Amazon is known to continuously have high rates of reinvestment, so that really keeps their free cash flow very low. So it's very hard to make a judgment based on the FCF ratio. And finally, tip number 4, which is a psychological one, where I want you to focus on your portfolio's value and imagine what it is in 10 years' time and not get affected by what it looks like in 10 days' time. So for example, when the Trump tariffs hit last Friday, the S&P tanked by up to 6%. And I was having dinner with a friend and then he said, hey, you see, the Trump tariffs happened and the stock market tanked by so much in one day. Hey, bro, the stock market is so dangerous. You should stop investing lah. Look, if your investing time horizon is in days, weeks, months, or just a year or two, then yes, the risk of losing money in the stock market is definitely very, very high. And I will urge you to look elsewhere in terms of asset investment, because then the stock market is just not for you. There's no quick gain, quick wins in the market, in my opinion. Because if we just take a look at the historical rolling returns of the S&P since the beginning of time, right, you will notice that as we go down on the left side from 1 year holding period all the way down to 30 years, the longer the number of years you remain invested, the lesser is the red bar on the left half of this chart, which represents losses. In fact, beyond a certain amount of time, which I think is about 12 to 14 years, these are rolling returns, by the way. You should Google and check out what rolling returns means. In my opinion, it's the most conservative estimate on the returns of the indexes. So I use rolling returns as a form of benchmark that I try to beat. But the point I'm trying to say is that beyond a certain threshold, about 12 or 14 years in the S&P 500 on the rolling returns basis, annualized rolling returns basis, historically there's been no losses beyond that. So the longer you invest, the lower your probability of losses, assuming that, of course, your underlying investment has strong fundamentals like the S&P 500 or a collection of businesses of high quality that are fundamentally strong with durable competitive advantages for the long term with good management, etc. And yes, so let's say you start with a portfolio of $100,000. How do you focus on the 10-year, what your portfolio looks like, instead of being, distracted by the 1 to 10 days, all this volatility that happens, right? If you have a $100,000 portfolio, and let's say you think you will do 15% CAGR on average, if you think you're good, or, your past few years of performance suggests that this is the kind of CAGR that you can get, then if you project at 15% CAGR over 10 years, now from year 0, 1, 2, 3, 4, your returns are going to be zigzag. The portfolio value is going to go up, down, up, down, up, down, 100K, 150K, maybe you lose some money and you get, the whole year you're waiting and the whole year is negative. Maybe this year could be a negative year, right? But it doesn't matter, because after 10 years at an average CAGR, compound annual growth rate of 15%, your portfolio, if you remain invested and not divest and just remain consistent with your thesis, will reach $404,000 from 100K. So don't be bothered by the short term, few days, few weeks. People saying, oh, your year to date, you're this and that. It doesn't matter, guys. What you should be looking for is to optimize your long-term 10-year and beyond CAGR, and to focus on what is that final amount of destination, the pot of gold you're going to get at the end of the journey. Don't be distracted along the way. Don't listen to all this time is different naysayers. Focus on your thesis, remain invested, be contrarian. So that's it for this episode, everyone. I hope you enjoyed this episode. Remember to click like and subscribe to support this channel. Thanks, everyone. Until the next episode.